Hello, everyone. Welcome to Auditor Independence Staff Augmentation Arrangements. My name is Kathy Allen. I am the managing member of Audit Conduct. Welcome to today's webinar, where we are going to focus exclusively on this new independence interpretation. A little bit of Audit Conduct, my consulting firm. We create customized training solutions for CPA firms, for audit committees, and other organizations. So without further ado, we've got a lot to cover in this 1-hour CPE program. Just a quick reminder, I know we all know this drill, but in order to obtain CPE credit for this program, you do need to respond to 3 out of the 4 polling questions that I will announce during the program, and be online for at least 50 minutes, 50. If you do have any issues from a technical perspective, please put something in the chat or the Q&A, and Linda, who is assisting me, will try to help you with that. Okay, so in this webinar, as I mentioned, I will be discussing a brand new interpretation of the AICPA independence rules. These don't come along every day. This is a little bit of a special event, I would say. This particular interpretation addresses staff augmentation, or also referred to as loaned staff arrangements with attest clients. Obviously, if we're talking independence, we're dealing with an attest relationship, an attest client. So the learning goals for today are that after this training, you should be able to identify the criteria for loaning staff to an attest client under this new interpretation, and also be able to apply a new provision for lending staff to an affiliate of an attest client under the client affiliates interpretation. And just to clarify that, it's actually not it's a new provision in an existing interpretation on client affiliates. So it's additional and was released along with this staff augmentation interpretation. I would also like to invite you to put any questions you may have about this subject matter in the Q&A option in the box for consideration, and I would do everything in my power to try and answer that while on the webinar. And if that's not possible, you can please feel free to follow up with me afterwards. All right, so, and just for informational purposes, we're having a little winter wonderland here in Long Island, New York. We're getting a little early March snowstorm. So those are always short-lived, so it's not so bad, and it looks kind of pretty. Okay, so in March of 2021, the AICPA Professional Ethics Executive Committee, or PEAC, released this new interpretation of independence called Staff Augmentation Arrangements. And that's, of course, an interpretation of the independence rule in the Code of Professional Conduct. And that addresses loaning staff to an attest client. So staff augmentation might be a strange word to some people, maybe not to you. But it basically exists that when a firm lends its personnel to an attest client to supplement or augment their existing staff for a certain period of time. And it does differ. We're going to get more into this as we talk about this interpretation and the related guidance, which was also released relatively very recently. But one of the questions that comes up quite a lot is, what is the difference between staff augmentation arrangements and a professional services engagement? And the primary difference is that in a staff augmentation arrangement, the client's management will be responsible for supervising your firm's personnel, right? If you're the audit firm, your personnel who would normally answer to your managers, et cetera, will now be taking their daily direction from the client, because they're basically being loaned to that client so that they can perform certain activities. And we'll get into all the specifics as we go through. So just my quick Disclaimer, I was appointed to the peak in May 2020, and any views that I do express in this webinar are strictly my own. They don't represent positions of peak or the AICPA. So let's break this down. There are two elements in these arrangements. First, the firm lends its personnel to an attest client to supplement the client's staff. And second, the client's management, not the firm, are responsible for supervising and directing the augmented staff. So the interpretation fills a void that used to exist in the code in that, and this is always the case, the code used to require, because lending staff to an attest client was not addressed anywhere in the code, you used to be required to apply the conceptual framework for independence. So that was a void in the code that was filled with this new interpretation. The other good thing about adopting this new interpretation is that it also converges the code with the provisions in the international independence standards. And those particular standards, and many of you know the acronym AICPA, that's the code issued by the International Ethics Standards Board for Accountants. They have a provision in their code called temporary personnel assignments. They're not perfectly converged, the AICPA code and the AICPA code on this subject, but they are closer than they once were because now at least the AICPA code does address the subject. So because the client is responsible for supervising your staff on a day-to-day basis, the appearance of independence is a prime consideration. And for this reason, the interpretation generally precludes a firm's staff augmentation arrangement with an attest client because of those appearance issues. However, the arrangement may be permitted under very limited conditions. And I should mention, before we go on to the next slide, that this was an instance where Peak issued two different proposals for staff augmentation. And some of the firms persons on this webinar, I know your firms commented on maybe one or both proposals. The original proposal was actually a more liberal interpretation that would have allowed firms to do staff augmentation in more instances. That did garner quite a bit of criticism from a few commenters, not many, and there were some commenters who thought that was perfectly fine. One of the main commenters who opposed the interpretation as written was the National Association of State Boards of Accountancy. So with that information, Peak did agree to go back and revise the interpretation. And when they came out with a new proposal, what they did was allow for some limited instances where these arrangements could be provided to an attest client for a very limited period of time, meeting certain specific criteria. And the reasoning, the rationale behind that was that in certain instances, there may be a public interest element where it makes sense to allow the audit firm to help the client who's in a dire situation for a very, very limited period of time. So, all right, so let's move on to when is staff augmentation permitted for an attest client. So specifically, such an arrangement would be permissible if the attest client encounters an unexpected situation that creates significant hardship for the client to make other arrangements. And the arrangement also needs to be short-lived, and that is presumably 30 days or less. But that's not all of it. Permissibility is also prefaced on the firm being able to apply several safeguards to protect the appearance of independence. I would say the 30 days or less certainly is a big piece of that, right? Because if it's extremely brief, that would help mitigate that threat to the appearance of independence. But let's take a look at some of the other safeguards that are required for performing these arrangements for an attest client. And just note that all of these are required. So first of all, at the time the arrangement is entered into, the firm does not expect the arrangement to reoccur. So it's pretty much seen as a one-time situation that needs to be dealt with, but you don't expect that 6 months or a year or even 2 years from now, you'll need to do the same. Secondly, the firm's augmented staff, the staff that are lent to the client, should not be participating or able to influence the attest engagement covering any period that includes that staff augmentation arrangement. So that's to mitigate against the threat of a self-review, where the same people that did the, went out and helped the client would also be auditing or performing other attest services with respect to that information. This may seem obvious, but the augmented staff can only perform activities that would be permissible under the non-attest services subtopic of the independence rule. So you can't augment your staff or lend your staff out to the client to be an outsourced CFO or to perform valuations that you would normally not be able to provide because of the independence implications. And the last of the safeguards is that the client needs to designate someone with suitable skill, knowledge, and experience to oversee the loaned staff's activities, and they need to pretty much determine the nature and scope of those activities. They need to supervise them. They need to, determine how adequate the results of the services are, etc. And we're going to get into this, but one other things that I think Peak really tried to do with this second proposal and with this final rule is to make sure we're referring to these arrangements strictly as that, as staff augmentation arrangements, even though admittedly they look and feel a lot like non-attest services. And we're going to get into that because that is an area of confusion that I think came up because of the way this interpretation was included under, in terms of category, it was included in the code under employment provisions. So, and that was to sync that up with the international standard, which also includes it under employment rules regarding employment with an attest client. It originally was proposed as a non-attest services interpretation. So we'll get into that, and I'll try to clarify those differences. All right, that leads us to polling question number 1. Let me see where that is. Okay. Take a look at that. This is a choose as many as you like situation. So which of the following conditions must exist for a firm to have a staff augmentation arrangement with an attest client? And you've got situation unexpected, creates hardship, will last 30 days or less. We've still got some more folks to respond. Okay, that looks good. And really, I would say for the most part, folks chose all 3. That is absolutely correct. Obviously, you don't have to get these correct, by the way, as you probably know. All right. And as you know, in addition to these 3 items, the safeguards that we discussed on the last slide would also all be required. All right, so I have to give credit to the Peak Task Force that worked on this interpretation. They were pretty quick in getting some frequently asked questions out the door on it to help firms in their application and their implementation of this new rule. So And this was to help firms implement the new interpretation. They updated the ethics division, updated its non-authoritative guidance in a publication called Frequently Asked Questions, General Ethics. So there's two frequently asked questions, well, it's actually more than two, but there's two main frequently asked questions that the AICPA ethics division issues. One deals with general ethics, and you will find independence in there except for non-attest services. And then there's a whole separate publication, Frequently Asked Questions, Non-Attest Services, which is just non-attest services. And they're both excellent references to have. You just have to keep in mind that the guidance in these publications do not override what's actually in the code. They're meant to supplement the code and provide some more context and understanding. Really, the only authoritative source for the rules is in the code itself. But these are extremely helpful, and people can certainly look to them in applying the code. That is the intention. And so what the division did was issue 5 new frequently asked questions, which I thought were extremely helpful. And so we're going to go through all 5 of them because they just help to clarify what was in the interpretation. And I mentioned this has been a point of confusion, I think, for some folks, and very understandable. And so the first FAQ asks, what is the difference between a staff augmentation arrangement and a non-attest services engagement? So again, I may be repeating myself, but forgive me. The primary difference is that in a staff augmentation arrangement, the client will agree, they must agree, to direct and supervise the loaned staffed activities. Once you give those folks over to the client, that's their problem, right? I mean, they should be going there knowing what the boundaries are of the activities they should be doing. That's a really important point that's not covered in these FAQs. That's just my own my own view, is that you want to make sure that folks know exactly what they are there to do and don't go beyond that, because as you know, with non-attest services that are performed for clients, and that you really can't totally distinguish this from non-attest services, because in essence, your staff is going to the client, they will be performing activities for that client. So you still need to be cognizant of what's permissible and impermissible. And as you recall, one of the safeguards is that your staff can only do activities that are permissible under the non-attest services interpretation. So that's the primary difference. In a typical non-attest services delivery, you know, you're going to actually be responsible for supervising your own staff. And so that is the main difference. And then what this FAQ does is just add a little bit more flavor to this by saying and I'm not quoting, this is my summation, a non-attest service engagement typically concludes with the issuance of certain deliverables that are subject to the firm's quality control processes. For example, a manager in the firm reviewing an associate's work prior to issuance to the client, right? That would be very typical in a non-attest services engagement. And that is, you know, one of the items mentioned in the FAQ is that that's also a distinguishing factor. Now, one of the questions that I've had come up has to do with the fact that some non-attest service work products, like a monthly bank reconciliation, may not require a specific review by an audit firm's supervisory personnel prior to issuance, but they may be subject to the firm's general oversight of the engagement as part of their QC process. And that, in my view, that would be sufficient to distinguish an engagement as non-attest services versus a staff augmentation arrangement. So here's another point to consider, and sorry if I muddy the waters here, but I just want to bring this out in case this is something you've thought about. So if you think about the non-attest services independence rules, they do require that an attest client's management review, approve, take responsibility for a firm's deliverables, right? If you think of a bookkeeping type engagement, that's part and parcel of providing that service in compliance with independence rules. And then that is because that review and approval serves as a safeguard, so to mitigate the threat that the firm will end up performing any kind of management responsibilities. However, that solely reviewing and approving in the context of a non-attest service engagement, that I wouldn't take that to mean that the client is directing and supervising your firm's activities. So for example, your firm's staff may propose journal entries to the client and then ask management to review and approve those entries to comply with the non-attest services rules. This is a non-attest services engagement, not a staff augmentation engagement, because you're looking to the client to perform that function. All right, so other FAQs, let's walk through the rest. They clarify the main precepts in the interpretation. One, that the event is not expected to recur, or the arrangement is not expected to recur. Two, that the results, the unexpected situation results, I'm sorry, the situation results in something that is unexpected to the client. And third, creates a significant hardship on the client. So all of these were covered in the following FAQs. All right, so let's look at a couple of facts and then ask a polling question. So let's assume that in February 22, your audit client, J Inc., suddenly loses a key employee. So assume your firm meets all the required safeguards, including that you did not expect this situation to reoccur, and you loan Dan, one staff person only, a senior associate, to Jay for approximately 3 weeks. During that time, Dan prepared various reports and analyses under the directions of Jay's treasurer, and these were all considered to be permissible non-attest services. So the question is, let's fast forward several months. In July 22, a flood damages some of Jay's computers and causes them to lose several property and sales tax returns. And these returns were all due in 2 weeks. Can the firm loan staff to help Jay meet its tax obligation? In other words, have you met the, can you say by accepting a second staff augmentation arrangement, have you met those requirements that, you didn't expect the previous one to recur? So I'm going to launch this as our second polling question, and you can please put your response to that. Okay, this is a quick group. I like that. That's great. Well, we've got a little bit of yes, a little bit of no, and a little bit of possibly. So let's break this down. I'm going to end the poll. Okay, so this question actually resulted in the most comprehensive answer of the 5 new FAQs. This is a matter of professional judgment, which I know is not always the most helpful answer in non-authoritative guidance. However, what the division did was provide several questions for you to walk through in order to come to that judgment. So here they are outlined in this slide. So, the requirement is that you should have a reasonable expectation at the time of the first arrangement that this was not going to be a recurring situation. And frankly, the fact that these events are separate and distinct, one would say the answer to this is no, that the firm did not reasonably expect when entering into that February arrangement, that their client would need another arrangement, or would need them to loan staff to them again in the future. I think, as long as the firm made a good faith judgment at that time that this was a one-time event. I mean, that's not to say they would never lose another key employee, but at the time, this was the expectation, was that they were going to help for this very brief period, and that this would not be something that would recur. And second question, how much time has passed since the previous staff augmentation arrangement? Now, unfortunately, it's only been about 5 months or so. So that's a pretty brief period that can impact the appearance of the firm's independence. So I think, with all of these questions, you're kind of putting them into a mix, and then at the end of the day, seeing what you come out with. But that probably does not work in your favor. If a year or 2 years had gone by, I think it's a lot more helpful. 5 months is a pretty brief period, but let's take a look at these other questions. Does the new situation differ from what existed in the prior arrangement? Yeah, it certainly does, which also would support the notion that the firm did not expect the first situation to recur. Would the work performed under a new arrangement be different than the work that Dan performed earlier in the year? Well, yeah. I mean, we know that Dan prepared treasury reports and analyses, and the new request is preparing tax returns. So there are different activities. And on that same note, would the firm lend the same staff person or people to Jay under this new arrangement? That too, if you're sending Dan back again after 5 months, again, you've got that appearance to be thinking about. I guess the answer to this is going to depend on the availability of other staff. Who do you have that has that particular skill set to help the client and respond to the client's needs? And certainly loaning the same staff person to the client would certainly have probably a negative impact on the appearance of independence. And last question, what are Jay's other options, if any, to address the current situation? So, how challenging would it be for Jay to engage another firm? That's going to depend on the nature of the services being requested and the availability of other service providers to meet the client's needs. So if you think about tax return preparation, it's obviously a widely available service, but other factors that you may want to think about is, how firm is the tax deadline? How long would the firm need to actually get these returns completed? There may be other appropriate considerations for this situation as well. Now, the FAQ also goes on and specifically cites appearance. It said that the firm should carefully consider the appearance of their independence before taking on another staff augmentation arrangement, and that even if independence in fact would not be impaired, but independence in appearance would be, the firm should not move forward with the arrangement. Keep in mind, even if the firm is unable to loan staff to the client, but the independence requirements for Nontest Services can be met, that's another way that the firm could help the client. All right, the next FAQ deals with this whole notion of an unexpected situation, right? Creating a hardship on the client to make other arrangements. It's a significant hardship on the client is the wording. So what this guidance clarifies is that the unexpected situation is an event or set of circumstances that was not planned for and was unforeseen by the client. The examples are sudden loss of a key employee, natural disaster, casualty losses such as fire or theft. And our illustration actually covered the first two of these, loss of key employee and natural disaster. On the key employee issue, the only thing I would say really needs to be considered as you're contemplating one of these is you need to be careful if a key employee keep in mind that you can't perform any kind of activities that would not be allowed under the Nontest Services rules. So that rules out any kind of management responsibilities or any kind of activities that would be subject to self-review as per the code. And so, if somebody is a key employee, but they're a chief executive, et cetera, you would have to be really careful about, and I think that would pretty much be a non-starter to be able to fill in for someone, even just the appearance alone, even if you stripped away some of the management responsibilities. I think that would be a really hard bridge to cross. I would just be really careful. In fact, when I was putting together a key employee example for this webinar, and I'm also hopefully, I think Journal of Accountancy will be publishing an article that I wrote on this subject as well, and you might recognize these examples. I found that hard because key employee to me sounds like a member of management, but it doesn't necessarily need to be. I think that's the point here, but just something to keep in mind in regards to staff augmentation. All right, so what is a significant hardship? Well, here's another firms should use professional judgment answer. In determining whether that unexpected situation will create significant hardship for the client. And here, you want to consider the urgency of the client's need and how long the attest client would need to engage another firm to prepare the tax return. So I'm going back to our example. I mean, keep in mind, as I mentioned earlier, I think one of the reasons why Peak thought that it was appropriate to allow these very narrow circumstances, to allow staff augmentation for these very limited instances, was that the public interest of helping a client who's in a pinch and kind of desperate. I mean, it's not like you can go out and hire a new service provider overnight, right? In many instances, that would be really challenging. So there is a public interest element that is considered here that would allow for that. And so if there are other service providers and maybe and the need is not that urgent, maybe it's not so important for the audit firm to be doing that work. That's, I think, the point. So effective date, this has came and gone, as I'm sure many of you know. As of November 30th, 2021, this new interpretation was fully effective. And certainly that applies to any new staff augmentation arrangements entered into, and for any that were existing on that date, unless they met the requirements of the new rule, they needed to be terminated to maintain independence. So a little bit after the fact, but those are the dates for this new interpretation. All right, let's launch our third polling question. It's looking like people do find the guidance helpful. I would agree. I thought the staff and the task force did a great job coming up with some good context, some good explanation regarding this new interpretation. Okay, so we're going to end that poll and move along. So, other changes to the code. Concurrent with this interpretation, Peak amended 3 existing independence interpretations: client affiliates, non-attest services, and agreed upon procedures. The biggest change biggest changes were to client. I haven't used my laser pointer. I feel sad that I didn't think of it till now. Client affiliates and agreed upon procedures actually have more of a substantive impact on application, and non-attest services was more to just make sure that people look in the right spot in the code for the guidance on staff augmentation arrangements. And that goes back to the issues I raised before about, gee, this sounds like a non-attest service. So, you know, the concern was that practitioners would look to the non-attest services section of the code 1.295 for the independence provisions, and they wouldn't find anything there. So that was a pretty simple, just pointing people to the right interpretation in the code. But let's go through a couple of examples for client affiliates, because this is a little bit trickier. And so under the revised client affiliates interpretation, as you know, client affiliates is basically the interpretation that says, except for these several items, you need to apply the independence rules not only to your attest clients, but to the affiliates of your your financial statement attest clients. And so on the slide is the pretty much shorthand definition of a financial statement attest client. And these are your clients for whom you perform either a financial statement audit or review or a compilation, and that compilation does not disclose a lack of independence. Now, under a new provision in this client affiliates interpretation, firms may enter into staff augmentation arrangements with certain affiliates of a financial statement attest client. However, like most exceptions to the client affiliate rules, this one would not apply to affiliates included in the financial statement attest client's consolidated financial statements. So let's take a look at an illustration. So company A is your audit client. It controls company B and it exercises significant influence over company C. And company A's investment in C is also material to A. So in this case, both a controlled entity and an entity that you have significant influence, that A has significant influence over and is material to A, those are both considered to be affiliates. But they are not only just affiliates, they also would be included in A's consolidated financial statements. Therefore, these types of entities are exempted from the exception that we're going to talk about. In other words, the firm could not loan staff to, say, company B or company C unless the arrangement met the same safeguards and conditions that apply to company A, the audit client. Okay, so I just wanted to take that off the table right from the get-go so we can talk about where there may be opportunities to do staff augmentation for an affiliate of a financial statement attest client. So a firm could potentially have staff augmentation arrangements with other types of affiliates. And an example would be either a parent or a sister company. And we're going to talk about a sister company situation in this illustration that you see on your slide. So PE is a private equity fund that controls 3 portfolio companies, X, Y, and Z. Company X is the audit client. And there's, we're going to assume the firm performs no services either for PE, for Y, or to Z. So only X is the is an attest, a financial statement attest client. And let's further assume that Z over here in yellow is completely unrelated to company X, the audit client. These companies are separately managed. They have separate systems. They do not share resources. They happen to be owned by the same PE fund, but that is where the similarities end. But they are considered sister companies. And we're also assuming for purposes of this illustration that both X and Z are material to the PE fund, and hence under the client affiliates definition, they would be considered affiliates. And so Z would be subject to independence provisions for that reason. However, because of this new exception added to the client affiliates rule for staff augmentation, what the firm can do in this instance is apply the conceptual framework for independence to determine whether loaning staff to Z would cause significant threats to independence with respect to the audit client X. Now, if that is the case, if there are significant threats identified, then the firm must apply safeguards that reduce those threats to an acceptable level to maintain its independence of X. Now, I said that I presumed that they didn't share systems, management, etc. And under that scenario, one would probably conclude that, unless there were other factors at play, they would probably conclude there are not significant threats, etc., and be able to, enter into a staff augmentation arrangement with Z. But let's flip that and say that Z and X do share resources or employees or management, etc. Now we've got a situation where there could be a significant threat to our independence at X by loaning staff to Z. Now, in that case, we will be required to apply safeguards that sufficiently mitigate the threats to an acceptable level, meaning that our firm appears to be independent in the eyes of a reasonable and informed third party. So examples of safeguards might be using separate personnel to perform the attest and the staff augmentation activities, vetting the situation with X's governance body to get their views in terms of, discuss independence and see their comfort level with this arrangement. Another option or additional safeguard might be to have an independent party perform a review of either the loan staff's work or the attest services. So that's the new provision under client affiliates. Let's talk about agreed upon procedures engagements. So these are a type of attestation engagement, and or the SSAEs. These are technical standards of statement on standards for attestation engagements. And there is a provision in the code, it's 1.297, that deals with these types of engagements. We're just going to talk about agreed upon procedures, but that 1.297 covers some other types of SSAE engagements. But what the PEAK did was scope out agreed upon procedures engagements to make staff augmentation allowable for an entity that your firm only performs AUP services for. So this would not apply to a situation if it was an audit client and you happen to also do an AUP for them. So the thing with AUP is that unlike the independence rules that apply to all other attest services, a firm performing an AUP engagement is not required to comply with the general requirements for performing non-attest services, and that you would typically be required to follow to perform any kind of non-attest service to an attest client. But the caveat is, and they can also, you can also provide to an AUP only client otherwise non-attest services that would otherwise be prohibited to perform for an attest client, as long as those services don't relate to the specific subject matter of your AUP engagement. So you've got totally different subject matters. And so what is shown on the slide is the new language, pretty much kind of mirrors, I think, what I just discussed. So let's say, the firm performs an AUP engagement related to compliance with specific regulatory requirements like HIPAA or something along those lines. But the firm's loaned staff would help the client with some routine bookkeeping. For example, they'd be reconciling bank accounts. You might see that and say, well, we're dealing with totally different subject matters, so we're okay to do this kind of work. Just keep in mind that agreed upon procedures, if it's the only attest work you do for a client, they are subject to a lesser independent standard, a modified independent standard, as you will. And so those staff augmentation arrangements might be acceptable for those types of clients. All right, going to launch our fourth and final polling question now. I mentioned that this interpretation went through two proposals, with the first proposal being more liberal than the second. When the second proposal was being considered, that's when it was suggested that while the peak could agree that the stricter stance might make sense for the attest client itself, that there should be some allowance for applying the conceptual framework to certain affiliates of a financial statement attest client. That was the progression here, because with that original proposal, there was no mention of client affiliates. This only came up when the second proposal became a lot tighter than the first. And then it was thought that, well, if we can't do this for attest clients, maybe, from a threat standpoint, we may be okay to perform it for certain affiliates of attest clients. All right, do you agree that a firm may loan staff to certain affiliates and maintain its independence? And a lot of you said depends, and I think that's a great answer, because in essence, it does depend. It's going to be a judgmental call at the end of the day, and so you need to take all the facts and circumstances and weigh them carefully and come out with a determination. And certainly, just as a reminder, when you do apply the conceptual framework, when you reach a conclusion that you have significant threats and you do determine that you have safeguards that you can apply to reduce those threats and move forward with whatever it is that you want to move forward with, there is a documentation requirement. So you want to make sure that that is going to be included in your work papers. Okay, getting to the end of the presentation now. I want to just circle back. I told you there were 3 changes to the code that came out with staff augmentation. We talked about client affiliates. We talked about AUP engagements and non-attest services. Because firms basically do deliver staff augmentation arrangements in something that looks an awful lot like a professional services or non-attest services engagement, there was a concern that people will look in the code under non-attest services. They're not going to see staff, lending staff, staff augmentation. They're going to say, oh, well, it's not covered. And they'll, hopefully they would know to go to the conceptual framework, but they don't need to do that now because we have an actual interpretation to converge with international standards. And because Peak did believe that much of what's underlying this interpretation has to do with the appearance of employment with the client, Peak did agree at the end of the day to categorize this under employment. So you will see it under, in fact, it's under simultaneous employment or association with the client. Now we understand it's not actual employment. We know the client, you know, your loan staff is not going there and actually becoming an employee of the client. It really is in appearance only. But that was the decision. And so in order to make sure that people go to the right part of the code and get the right guidance, there is now a provision under Nontest Services that basically directs you to an interpretation called current employment or association within a test client. All right, last thing, I'll point out a couple of real nice resources. We've been talking about the FAQs, so I'm going to guess many of you are already familiar with that publication that I mentioned. There's also a podcast specifically on this. The AICPA has been really churning out podcasts like crazy. I know a lot of you from my emailing list, you probably know about the Back to Basics series. They're doing I think it's a 10 podcast series on the code of conduct. And they have numerous other podcasts from probably the last couple of years, I would say. Some of them being like meeting summaries from Peak, but a lot of them just being various subject matters. And one of them was on staff augmentation. So you may want to check that out as well and share it with your staff or whomever you think would benefit from seeing that. And that concludes my presentation. I'm just going to end on this and note that I have developed in recent years some self-study educational products on the code of conduct and on auditor independence. You may want to check that out. And I think that just about does it. I want to thank you for your attention. I don't believe any questions came in, but we do have a couple minutes left on the clock. So I'm not going to, hold on. I do see something in there. Okay. How do these rules change our ability to assist with new standards? Great question. You're actually touching upon another new interpretation of independence that is coming down. It should be released in final form soon. At the February Peak meeting, Peak voted to adopt a new interpretation on helping clients implement accounting standards. What are the kind of the goalposts? It's not terribly detailed, but it does provide some interpretive guidance. Certainly a lot of what applies is in the code already, just maybe in different places in the code. So this is kind of a nice compilation to help people with that. I would say in terms of staff augmentation, you would not be able to, I think an accounting standard implementation, I would see as strictly as a non-attest service offering, and I would look for that new interpretation. The final should be coming out soon. I think it's going to be in the April Journal of Accountancy, and won't be effective for about 6 months, but can be implemented early. But I would say I wouldn't see it as a good candidate for staff augmentation because it would not necessarily meet the criteria of being an unexpected situation and causing significant hardship. And I wouldn't count the client not just kind of kicking the can down the road for too long as being an unexpected situation. I don't think that would be within the spirits of the standards, but you can look forward to a standard coming out that will specifically follow or specifically address your question about assisting with new standards. So I think you will find that to be helpful. Any other questions before we call it a day? All right. Well, I'm going to thank you once more for joining today. I hope you got something out of this webinar, and I wish you a very lovely rest of your day. Take care, everyone.